Alrighty. So in today's video, we're going to be talking about the zebra option strategy. So if you're ready, let's dive right in with the very first thing as to what exactly is the zebra. Why is it called the zebra? So first of all, this is actually designed by the Tasty Trade team, and they call it the zebra because it's just a short form of what the name of the strategy is. So as you can see over here, the actual name of this zebra is the zero extrinsic back ratio spread. So if you've seen some of my videos on my channel where I talk about the ratio spread, those ratio spread is actually the opposite of the back ratio spread, the front ratio spread. So those are credit strategies where you receive a credit upfront for putting on the strategy. But for the zebra, it's the opposite. The back ratio spread is basically a debit kind of strategy. So you actually have to pay for you to put on this strategy. So why is it called the zero extrinsic back ratio spread? Well, because the construct is in a way where you actually eliminate the extrinsic value from the option. So first of all, the zebra is a stock replacement strategy where it aims to mimic the profit potential of a stock position, but with lesser capital outlay. Now, this is similar to the deep in the money leap strategy, which I've also shared on my channel. However, there is no extrinsic value decay, and also you get lesser capital outlay compared to the leaps. So at first, it does sound pretty enticing, right? Pretty attractive, but there's always kind of a trade-off. So this is something that I want you to be mindful of before you decided to, hey, I'm gonna go all in on this zebra, and then just realize later on that, hey, there's something that you need to really beware of before you actually decide to trade the zebra. But at the initial glance, you can see that the zebra certainly sounds like a pretty good strategy. So next, let's talk about how do you exactly construct the zebra option strategy. So for the zebra option strategy, there is the bullish zebra and there's also the bearish zebra. So let's first talk about the bullish zebra. So when we are talking about the bullish zebra, we're going to be using call options. And with the bearish zebra, we're going to be using the put options. So for the very first step for the bullish zebra, you want to select closest to the 45 DTE options. So you notice this is slightly different from the deep in the money leap strategy where we are really going far out in time. But for the zebra, according to the Tasty Trade team, the way that they design it, they actually want to go for a shorter term option DTE. In fact, according to their guidelines, they're actually going somewhere from 21 DTE to 45 DTE. But for this example, in this video, I'm just going to be talking about the 45 DTE one, mainly because of how we're going to manage it. And later on, I'm going to share with you a little bit more as well in the later slides. Now, the second step, this is where you buy two call options at the 70 delta. As you can see over here, so this is going to be in the money. And for the third step, you're going to sell one call option at 50 deltas. So this is going to be at the money. So this is the bullish zebra. Now for the bearish zebra is pretty similar, but now we're just using the put option. So step one, similar, select the 45 DTE options. And step two, buy two put options that's in the money at around 70 delta. And step three, you want to sell one put option that is around at the money, which is somewhere around 50 deltas. So this is the construct of the zebra option strategy. Now at this point, after seeing this construct, you might be asking, why is it constructed in this way where you have, two long options and one short option? And more importantly, why is there a short option in a stock replacement strategy? Because if you think about this compared to the leaps option strategy, which I shared in my channel, you'll notice that for the leap strategy, we are just buying option. Because the whole idea of the leaps is to serve as a stock replacement strategy. So we are buying the leaps option. But for this zebra, there is going to be a short option as well, as you can see over here. So why is this so? Now for this, we want to head over to the option chain to kind of understand why. So we're going to use SPY, and I'm using this on the Thinkorswim web platform. So first of all, step one, let's go over to the closest to the 45 days DTE. So this will be the closest one, so 46 DTE. Now, if you recall, what we're going to do is we're going to buy two options at around the 70 delta mark. So you can see over here, this is the delta column. So what we're going to do is we're going to select the 70 delta. So we click on the ask because we are going to buy this option down here. So we're going to buy two of this. So let me change the number here to 2. And then now, if you recall, we are going to sell one call option that is at the money. So it's going to be somewhere around 50 delta. So at the money in this case, let me just go for this 54 delta one. So for this, I'm going to choose the 590 strike price, and I'm going to click on the bid because I'm going to sell this call option now. So remember, the construct is to have two long options at the 70 delta mark, and we're going to short one option at around the 50 delta mark. So this is the construct down here. Let's take a look at how exactly does it look like on the P&L graph. So let me just scroll down over here, and there we go. So this is how the zebra looks like. What you notice on the right hand side is that there is unlimited profit potential. So the whole idea here is as a stock replacement strategy. So as for a stock, if you buy the stock, as you know, there's going to be unlimited upside. So similarly, there's unlimited upside as the market goes up. But on the downside, in contrast to a long stock position, you actually do not lose money all the way to $0. As you can see over here, it is actually kept to a maximum loss. And in this situation, you can see over here, it's $44.64, which just equates to around 4,000 plus as the max loss. So for example, if the market actually crashes all the way down, let's say it goes all the way to maybe $400, well, guess what? You would only be losing the maximum of around $4,400. But if you were to go for the long stock position, then you're going to be losing a lot more, right? Because if you was to go all the way to $400, then you're going to lose roughly about $19,000 if you were going to buy 100 shares of stock. But for the zebra, you're going to lose much less. In fact, it's just going to be a fraction of it. So this is the zebra. So why do they call it zero extrinsic? So this is the key for this strategy. And the whole idea for this strategy really is to eliminate the extrinsic value when you are buying options. So for example, if I was to just remove this option down here, so let me just remove this, and I was to just change this to just one option, let's take a look at the 70 delta call option in isolation. Okay, so this is the P&L graph down here. You can see it's very similar to the zebra, but what I want to show you is this blue dotted line down here. So I'm not too sure whether you can see it. What I'm going to do is I'm just going to draw over it so you can see how this blue line looks like. So this blue line down here actually depicts the P&L for the current day. That means on the day that you put it on, this is going to be the P&L depending on where the market actually goes to. So for example, if today the price, let's say, just jumps to about $600, let's say for example here, then your profit, okay, take a look down here. You'll want to look at the top line down here, this first one, which says P&L June 3rd. If we go to about $600, you can see that the P&L is about $744. However, at the expiration date of this option, you notice that it goes down to almost a negative $200, as you can see at the bottom down here. So this is exactly what I mean by extrinsic, because over time, the extrinsic value will decay and go to zero at expiration. So that is why, as you can see, if the market was to go up, and as time goes by, your profit actually kind of get lesser because there's the decay in the extrinsic value. Now, the zebra, the whole idea here is to get rid of this extrinsic value decay. That means to say the moment you put it on, there is no extrinsic value decay to the upside. So whatever you make is going to be similar to a long stock position. So how do they actually do that? And they do that by actually eliminating the extrinsic value that you have gotten when you buy those call options. So as you can see over here, let me just go back to the zebra construct. So over here, we have two of this call option. So if you see this two call option, what you want to take a look at is this extrinsic value column down here. So I'm just going to circle this. You can see that there is some extrinsic value over here. So this is exactly what you are paying as well for this option. Because as time goes by, this is eventually going to zero and you're going to lose that value in this option. That is why you notice that the P&L graph actually drops as time goes by, right, on the way up as you saw just now. So this is where the short call option actually comes in. So the whole idea here is to use this short call option to remove the extrinsic value that you've gotten from buying this one. So if you buy two of these call options at 70 delta, you're roughly going to get about $22 in terms of extrinsic value. So with this, they're trying to cancel out the extrinsic value. So as you can see over here, this is roughly about $16. So $22 minus $16, you're still going to be left over with roughly about $6 in extrinsic value. So if you were to take a look at the P&L graph, okay, so as you can see over here, this now does not look correct. So you know something is wrong. And that's because we have two short call options. So we're going to change this to one call option. So as you can see over here, we do still have some extrinsic value decay. So this is not 100% removal of the extrinsic value. So there is some adjustment to make. But at least in this case down here, the extrinsic value is going to be lesser compared to if you just buy one of those 70 delta call option. Because with the 70 delta call option, just one of them, you're going to have $11 in extrinsic value. But with this zebra construct, you're only going to have $6 in terms of the extrinsic value to decay. So almost half of it. Now, this is where we do actually want to adjust it if you want to get a perfect zero extrinsic value. So let me just show you how to do that. So for this, what you're going to do is that you need to estimate based on the extrinsic value that you are selling down here. So if you're going to be selling roughly about $16 of this, it just means you need two of these call options that you're going to have roughly about $8 extrinsic dollars of value. So what I'm going to do is I'm going to find the option strike price that gives me an extrinsic value of roughly $8, because $8 times 2 is going to be about $16. So I need to go even deeper into the money right now. So this is where I may need to go to a much higher delta in order for me to remove the extrinsic value. So here we go. Right, as you can see over here, this is roughly about $8. This is about $7.80. So let us take a look at the extrinsic value that we are going to remove after we sell this. So it's roughly about $15.80. And if we divide that by 2, I think it's roughly about $7.90. So we want to find something that's almost as close to that. So there we go. You can see over here, based on this option strike price, the extrinsic value is about $7.90. So 2 of that is going to be about $15.80. So I'm going to click on the ask down here and I'm going to go for 2 options. So I'm going to buy 2 of this and I'm going to sell 1 of this at the money. So by having this construct, hopefully our P&L graph is going to be whereby the blue line is not going to be much higher than where the P&L graph is at expiration. And if we have a perfect zero extrinsic, it's going to be exactly the same. So let's take a look and see whether we have gotten it. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so as you can see over here, it's pretty close, right? The blue line, if you can see it, let me just draw over it, it's just very slightly above the P&L graph at expiration. So what does this mean? It just means now our extrinsic value is not that much, right? There is still a little bit, but not a lot. So can we actually adjust this so that we really get zero extrinsic? And the answer is yes. All you got to do is now go for the even deeper in the money strike price. So in this case, we might even go overshot the extrinsic value that we want to kind of remove. So if we were to remove this, I'm going to go for the 547. Same thing, I'm going to buy 2 option contracts over here. Now let's take a look at the P&L graph. Okay, let me just remove the drawing. And here we go. Okay, so pretty close, right? So it's just slightly above, but pretty much is almost considered zero extrinsic value. So this is exactly what the Tasty Trade team is trying to do. They're trying to mimic a long stock position where you get the same upside as a long stock position, but you're going to have a much lesser capital outlay. As you can see over here, the capital outlay for this is $86, which is about $8,600. If you take a look at the max loss on the left hand side, you can see over here it says $8,600 is the max loss for this zebra option strategy. If you were to actually buy SPY and you were to buy 100 shares and to get this same upside potential, it's going to be around $59,000. So that's going to be much more compared to this. So as you can see over here, this zebra strategy is how you can actually have very huge gains, because if the market was to go up, you make the same amount of money as a long stock position, but because of the smaller capital outlay, your return is much higher. So let me show you exactly what I mean over here. So let's just say, for example, SPY was to go up by $10. So now the price is around $590. So if it was to go up about $10, it's going to be about $600. Now, if you were to buy the stock itself, let's say you buy 100 shares of SPY, then $10 in gain of the underlying is going to net you roughly about $1,000 in profit. However, you're going to lay out about $59,000 to make that $1,000 profit. But for this zebra strategy, what you notice is that at the $600 mark, look at the P&L down here, right? The P&L is actually showing you that you get a gain of about $1,000 as well, and actually even more today itself. So the blue color line actually tells you your P&L today at the point of time where you put it on. So you can see that at the time you put it on, you have about $1,200 in profit, and expiration you have about $1,000. So we have slightly more profit today is because the extrinsic value has not decayed yet. So that's exactly what I mean by the extrinsic value decay over time. So the difference down here is that with the zebra, you make the same upside profit, but the capital outlay is only $8,600 compared to $59,000. So with that, your return naturally is going to be much, much higher. That is why you get the huge gains. Now, before you say, oh my goodness, this is such a great strategy, I'm going to put all my money into this instead of buying, SPY outright as a stock, you need to first be mindful that there is actually a catch. So there is a catch. So what exactly is the catch? Well, as you know, if you're going to have this kind of leverage in terms of the return, then on the downside, you're going to be losing quite a bit more in terms of return as well. So let us take a look on the downside, because if you really pay attention to this graph, what you notice is that this is not exactly a very simple straight slope down here, because it actually accelerates a little bit more steeper past this point down here, at this red mark down here. Past this point, you notice it actually starts to become a little bit steeper. So let us examine this part so you know exactly what the catch is. So if, let's say, for example, the stock was to equally go down $10. So if it was to go down $10, let's say to $580, let's try and identify where's $580. So $580 is roughly around here. Now, if you were to hold the shares position, the long stock position, 100 shares of this will net you a loss of roughly $1,000. But what about the zebra strategy? Well, as you can see over here, today itself, on the left-hand side, just based on the blue line, you can see today itself, you're going to be losing about $1,000 as well, right? Close to $1,000. However, if you was to hold this closer to the expiration date, what you notice is you actually start to lose more than if you were to hold on to the share position, because now you're going to lose double. As you can see over here, it says negative $2,000. So for the same movement downwards, about $10 down, if you were to hold on to this position, as time goes by, you're actually going to start to lose more and more compared to if you were to hold the actual stock position. And if you were to go all the way down here, the slope down here actually gets even steeper. So let us examine this. So let's say, for example, I go all the way to $560. So this is about $30 down. So based on the long stock position, you'll be losing roughly about $3,000. But take a look at the zebra option strategy. Today itself, you're going to already lose about $3,000. But if you hold on to this position for maybe 1 week or maybe even 2 weeks, you're going to lose more than that. And if you hold all the way to expiration, this is going to net you a loss of close to $6,000, which is double what you will lose if you were to hold on to the long stock position. So this is where you really need to be aware of, because you don't want to just say that, hey, $8,600, that's all my max loss. That's so little. But it's actually not the case, because you actually lose more for this region down here. From here all the way to here, you actually lose a little bit more. And it's only from here, if the stock really goes much further down, then this where is the cap in the loss actually does become an advantage. But before that, if the stock doesn't actually go down that much, this zebra strategy actually can lose you more than if you were to buy 100 shares of the underlying. So this is something that you must really pay attention. Okay, so now that we know exactly why the zebra is constructed in the way that it's constructed, let's talk about trade management. So trade management, let's first get into the take profit. how do you exactly take profit on the zebra? So the zebra is a stock replacement strategy. So the first way that you can take profit is actually going to be very similar to how you would take profit with a long stock position, because unlike a short option strategy where your profit potential is actually capped, for the zebra option strategy, there's actually no cap into the amount that you can make, because as I mentioned, this is meant to be a stock replacement strategy. So as long as the stock continues to go up, you will make more and more. So this is where you need to have an idea where you're going to get out. So this can either usually be a profit target, whereby you tell yourself how much money you want to make and then you exit based on that, or maybe a price target. So the price target could be what you see on the chart. So maybe, for example, you might say that, hey, there's a resistance over here, then you could get out once the price is close to here, and you get out of this whole position for the profit. So that's one way. Now, the second way, this is if you want to use the timing of the options as a way to exit, then you can either exit or roll at 21 DTE the latest. And this is very important because you actually have a short call in this setup down here. You notice this is a short call. So if you're going to be in profit, it just means that the market is going above your short call option, and that means your call option is actually going to be in the money. If you're going to be in the money in this call option, then there's always a chance that you can get an assignment on this short call option. And that means you're going to be short 100 shares of the underlying. So it's going to be a little bit messy to kind of unwind it. So if you do not want to get into the situation where you're going to get into an assignment for this short call, then you want to either exit this whole position at 21 DTE. So that's the time whereby it reduces the chance of assignment, or you can actually roll it at 21 DTE. And by rolling, it just means that you still have a very bullish view. So for example, maybe the market is at this point and it's already 21 DTE, but you think there's still more upside to go. So one of the things that the Tasty Trade team actually do is that they will close out this position and re-establish it again. So you're going to have a new zebra, but it pretty much just means is that you're closing it out and putting on a new trade in the form of rolling. So this is how you take profit. Now, what about managing your loss? What if the market didn't actually go up? Instead, it went down. So if it goes down, then the first thing you can do is that you can exit or roll once the price actually breaches the long call down here. So this is a management strategy that the Tasty Trade team actually was the one to come up with. And they mentioned that if the price was to go down to the point where it touches the long call, then you just roll it. That means you just want to re-establish the whole position again. So they're just trying to wait until the point where the market eventually goes up, and they're just lowering the structure. But that doesn't mean that you will eventually be profitable. So this is very important again to understand. So rolling doesn't necessarily mean that you will still be profitable in the long term, because it all depends on the underlying that you're placing this on. If this underlying just keeps going down, especially if it's the bear market like the crash in 2022, then you're going to lose a lot of money by rolling. So sometimes you need to know when exactly to exit it. So you can also consider a breach of the long call as a place for you to get out of the trade. So that's one thing that you can consider doing, because when you hold on to the trade, as you have seen just now in the P&L graph, you actually lose more and more over time. So the last thing we want to do for this zebra option strategy is to hold on to this trade for too long. Now, the other way is to exit/roll at 21 DTE. And again, because the loss actually increases as it gets closer and closer to the expiration. So this is exactly how you manage the zebra option strategy. And by the way, this example is for the bullish zebra. So the bearish zebra is pretty much going to be the same as well, but just for the put side. Alright, so this is the zebra option strategy. So let me know in the comments below what you think about this option strategy. And if this video has been helpful for you, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more options trading videos like this. And I will see you in the next video.